We'll be looking at the 2018 paper. Question number 1 is on financial statement analysis. So financial statement analysis basically it helps us interpret statements, financial statements, like the comprehensive statement of the comprehensive income statement and position. It also helps us to provide information that is essential for a company's position. By analyzing these statements through calculating these various ratios, such as liquidity, profitability, efficiency, leverage, we'll be able to give a position of how well a company is doing. So the ratios that we will come out for us will be ratios like the liquidity ratios. And when you're doing liquidity ratios, basically, you want to measure the company's ability to meet its short-term obligations. The most common ratios under liquidity, we look at the current ratio, the cash ratio, the asset test ratio. So for these ratios, you need to understand that a higher ratio will give you better liquidity. But excessively high ratios also may suggest that we are underutilizing our assets. Okay. Then we also look at profitability ratios. These ones are going to help us evaluate the company's ability to generating profits relative to the revenue, relative to the assets that we have. So when you're asked to calculate these profitability ratios, we want to look at how well we are using our assets to generate revenue, sales. Okay, then we're also going to look at investor ratios or investment ratios. These are ratios that will help us assess the returns generated from the investments in assets or in equity. So the return on assets or return on equity are therefore important ratios that will help us measure the efficiency in resource utilization and also in shareholders' returns respectively. So improving these ratios often will indicate effective management or utilization of resources. We also look at efficiency ratios. Efficiency ratios like the debtors days and creditors days. So when you're dealing with efficiency ratios, we're looking at gauging how effectively the company is managing the assets and liabilities, like the debtors days, creditors days. These ones will measure the average time it takes to collect our receivables or to pay our payables respectively. So decreasing debtors days and or having a stable creditors days will suggest that we're efficiently managing our working capital. So we also have financing structure ratios. Okay, so these ratios basically are important because they help us analyze the proportion that the company has of debt and equity in the company's capital structure. So the total long-term loans to equity ratio actually helps us reflect how companies' reliance on debt in financing its relative equity. Okay, so optimizing the capital structure in balancing it up will actually benefit the organization. Then also we'll look at how to interpret these ratios. So the financial ratios analysis will actually give us an insight into various companies' financial statements. Interpreting these ratios in the context of industry norms, we interpret these ratios in terms of the historical trends, also under company-specific factors. So these ratios will be analyzed alongside the qualitative factors to gain a comprehensive understanding of the company's performance. We also make recommendations as financial analysts to put on actionable recommendations that will help firms make decisions. So we'll also identify the areas of strength, also the areas of weaknesses, and also propose strategies of improvement. So this is basically an overview of what this ratio analysis is all about. So we're going to look at some of the ratios in particular. So this basically has a balance sheet.
Question, sorry.
Yes, please.
Gearing ratio. What is it all about?
Gearing
And it
ratio.
falls under which category?
There's a question, gearing ratio, under which category does it fall?
Under financing structure.
Under financing structure, okay?
Financing / capital structure.
Yes. So what do gearing ratios measure? So when talking about gearing ratios, these are also called leverage ratios. They actually measure the extent to which the company relies on debt relative to equity. So these ratios basically assess the proportion of debt in a company's capital structure. So there are two common gearing ratios. There's what we call the debt to equity ratio, and also the equity ratio. The debt to equity ratio is simply the total debt over equity. So here, if we have a high debt to equity ratio, basically it means that a significant portion of the company's funding comes from debt, which may pose what we call a financial risk. So a low debt to equity ratio suggests that we are conservative in our capital structure. We rely more on equity financing, so which also indicates stability. The equity ratio also is simply a ratio which measures the proportion of a company's assets financed by equity. It's simply the total equity over the total assets. So the higher the equity ratio, the lower the reliance on debt and the stronger financial position. So these gearing ratios are important because they give us insight on our financial risk assessment. It also gives a picture of the investor's perception on how our company is being managed. All right. So I hope.
Mr. Collins.
Yes, sir.
Yes. What about the interest cover ratio?
Okay, so we have another ratio which is called interest cover ratio. We're ahead of it. Another important ratio, which is also sometimes called the TIE, the times interest ratio. So this one basically is used to assess a company's ability to meet its interest obligation on an outstanding debt. Basically, this ratio indicates how easily a company can pay interest expenses from its earnings before interest and taxes. So usually banks are interested in these because once they give you a loan, they want to know your ability to covering your interest. So this ratio is very important to also creditors and investors and analysts because to give them insight of the company's financial health and ability to run away from the risk of default. So interest cover ratio is given by interest before interest and tax over the total expenses. So when you calculate this interest, basically, if you get a higher TIE or a higher interest cover, it means that the company generates sufficient income to cover its interest obligations. If you have a lower, means there's an ability to default on interest. So banks love the TIE, and the ratio which is above 2 shows that the company is what? Is financially healthy. So the threshold or benchmark should always be 2 times. So it shows that, okay, this the volatility is not volatile, okay? So the significance of this ratio basically is in creditworthiness, investor confidence, also in financial planning. How are we going to cover our interests? I hope I've explained.
Mr. Collins, I think on the formula you indicated that interest cover is the profit before interest, tax over expenses. Is it not supposed to be over interest? PBIT over interest.
I said over interest expense.
Said, oh, interest expense. Okay.
Yes, the interest expense.
Okay, thank you. Okay, thank you.
Okay. Any other concerns before we start looking at this question? So now,
How best can you memorize these formulas?
so he'll give you particular formulas. Each category has easy formulas. Not all of them that you need to know. These ones are very basic. All right, so let's go to our question. We have, I don't know why he loves Kandolo Limited. Company prepares a report analyzing the financial statements of Kandolo Limited, 30th December 2016, based on the income statement and the financial position. So here we have a comprehensive income statement. Okay, I'll not read all the units in there, but we know how the income statement looks like. And we have our key revenue here, gross profit here, operating profit here, profit before tax here, and profit for the year. Here we have the total assets here, the current assets, total assets there. Also have our total equity here and our loans. Also have our current, non-current liabilities, total current liabilities, total equity and liabilities. So we're asked to evaluate our liquidity ratios. So liquidity ratios, we have three: the current ratio, cash ratio, and acid test ratio. So at least let's come up with, let's go with the formulas. What is the formula for the cash ratio? Let's start with the current ratio. Current ratio, what's the formula?
Current ratio is current asset over current liability
Current liability is correct.
times 100.
So we
Okay.
now do for each of the years, 2016 and 2017. So let's identify what is our current assets for 2016, what's the current assets for 2017. So we go to the balance sheet, current assets for 2017. 2016, what are the current assets? This figure, 1.1 million, divided by the current liabilities, which is what? What is our current 427? Our current liabilities, yeah, 424. Okay. Are we there? So on the liquidity ratios, we're just comparing the figures. You need to know how to locate which ones are the interest of time. Let me just go to my solution sheet. 20 and 2016. I just need you to understand how to locate the particular figures. Okay, I'm not very much concerned with the solutions per se. So we go to current ratios, current assets over current liabilities. So for 2016, it was 1.1 over 424. So this is 2.7. And in 2015, when you go to our statement, we have what? current assets 1005 over current liabilities 398. So this is 1005 over 398. So we're seeing these are the two figures, 2016 and 2015. Okay, both of them are above what? 2. So these are good. Then the cash ratio is cash and cash balances over the current liabilities. So it looks at what cash is available to meet immediate cash obligations. So you need to add the cash and cash balances or cash and cash equivalents. So when we go to our statement here, the last part here, this is the figure we use against our total current liabilities. Okay, are you following? So
Yes.
this is how we calculate it. So 259 over 424, 37 over 394. So we have 0.6 and 0.09. Okay, then the quick test ratio or the quick ratio, simply current assets minus inventory over current liability. So it's this figure, we just subtract our inventory. Okay, so 1.7, then we identify the inventory. Inventory is our stock. So we remove the 800 stock on each of them. So here we 853, 826. So here we have 0.7 and 0.45. Okay, are we together?
Yes, Mr. Kwon, what is the explanation on the quick ratio? What is it that it looks at?
So what does a quick ratio look at? You know, sometimes our creditors will want to get their monies there and then. So we want to say, no, some of the monies are, we haven't sold some stuff. So the quick ratio basically negates the inventory. So it measures the company's ability to pay off its short-term liabilities using the most liquid assets, which exclude inventory. So the quick ratio provides a more conservative assessment of the liquidity ratio than the current ratio itself. Now let me interpret those ratios, all of them starting with the first one, which was the current ratio. We know that the current ratio is simply a ratio which is used to pay off its short-term liabilities with the current assets. So if we have a higher ratio, it means a stronger liquidity and better ability to meet our short-term obligations. So here, the current ratio increased from 2015 to 2016. You can see there from 2.52 to 2.76. So this suggests that there's an improvement in the company's liquidity position, as it's now more liquid, as we have more current assets to cover the current liabilities. Of course, we know current ratio must be above 1. Okay, so both of them generally are showing a favorable liquidity. When we go to cash ratio basically measures the company's ability to cover its short-term liabilities with cash and cash equivalents alone. So if we have a higher cash ratio, it indicates that there's stronger ability to meet our short-term obligations with readily available cash. So in here, we're able to see that it increased significantly from 2015 to 2016 from 0.09 to 0.61. Now, this is a substantial improvement, which suggests that the company has higher proportion to cover cash, to cover its short-term obligations with liquid cash. Now, ideally, the benchmark is that the cash ratio should be above 0.2. So here we have a general satisfactory story to tell that the company has sufficient cash to cover the obligation. So Candor Limited has increased in that capacity in 2016. The quick ratio, in this case, the quick ratio here suggests that the company is able to meet or pay off its short-term obligations using the most liquid assets. So here we are seeing the ratio increase from 0.45 to 0.78. So this indicates that there's a significant improvement in liquidity. So this suggests that there's a higher proportion of liquid assets, okay, excluding inventory. So the implication of this ratio basically is that if you're above 1, the company is most liquid and sufficient to cover its short-term liabilities without relying on inventory. So this increase signifies an improvement in liquidity and stronger ability to meet what? Short-term obligations. So the overall implications just on the liquidity ratios is that there was substantial improvement in liquidity, starting from the current ratio, cash ratio, asset ratio. All these increase, and this suggests that there was stronger ability to meet short-term obligations using the current assets and cash reserves. So these improvements basically gives a very positive vibe. Don't use that word. Picture for the financial health of the company. Okay, any suggestions? Any additions?
Maybe on the cash ratio, you said that it should be, is it above 0.2?
Pardon?
On the cash ratio, you said the acceptable is that it should be above 0.2.
Exactly.
Oh, okay.
Yeah. The cash ratio general must be above 0.2. The even the quick ratio, although the ideal, even the current ratio, although the ideal is for every 2 assets, you must have 1 liabilities. The actual, well, the quick ratio is 1:1. So at least you should have these benchmarks in your head. Okay, so I think I have done my best to explaining the liquidity ratios. Okay, you get your 6 marks just on these ratios. Okay, there's 6 remaining. 10 marks. 1, 2, 3, 4, 5. Oh, so maybe it's 2, 2. I don't know how his breakdown is. Okay, so profitability ratios. So profitability ratios, we have the gross profit margin and the operating profit margin. So these ratios are important because they help to see the profitability, ability to generating excess profit based on the revenues. So we have the formulas that we can give. Who can assist the formulas? Profit, gross profit percentage, and the operating profit percentage. In the interest of time,
Is it gross profit over sales times 100?
Yes, gross profit over sales, in this case revenue times 100. Then operating profit is operating profit over sales times 100. That's true. So those are the 2. Okay. So now let's interpret these ratios. So the profitability ratios, they give us insight on company's ability to generating profits from the operations and from the assets. So we'll look at Kandolo's operations for 2016 and 2015. So under our gross profit, which measures the proportion of the revenue that exceeds the cost of goods sold. So this represents the profitability of the company's core operations before we deduct the operating expenses. So let's look at the analysis. For the 2 years, Kandolo Limited gross profit remained relatively stable. So this simply indicates there has been consistent profitability in its core business activity. So the gross profit percentage of around 40 to 45, that one basically gives the company relative ability to manage its goods and services relative to its revenues. So the implication of having a stable gross profit percentage simply signifies that there's efficiency in cost control and pricing strategy. So this contributes to overall product profitability. However, when we have declining profit margins over time, it may indicate that our pricing pressures are rising, production costs are increasing, and also changes in the product mix. So our current position is still 44, fairly stable, okay? Of course, there's a slight decline in decimals, but this is stable. All right, so we go to operating profit percentage. So operating profit percentage basically measures the proportion of the revenue that remains after deducting both the cost of goods sold and the operating expenses. So this reflects the profitability of the company's ongoing operations. So here we can see that Kandolo's operating profit percentage slightly decreased from 7.78 to 7.92 in 2015 to 2016. So this indicates there's a slight decline in profitability from core operations. So whilst we can agree that we're still maintaining a positive margin, the trend needs, or it warrants, some further investigation into the cost management and operational efficiency. So this decreasing profit percentage may indicate some inefficiencies in operating expenses and also decreasing margins in the company's primary business activities. So it also may suggest that they need to operationalize or to optimize operations to maintain and improve the profitability. So this slight decrease is worth mentioning. So overall, what I can say on the profitabilities for Kandolo Limited for 2016, there's a stable but slightly declining profitability compared to 2015. So whilst the company still is maintaining a healthy gross profit margin, there's a slight decrease in operating profit percentage, which indicates that there's potential challenges in managing the operating expenses or maintaining the margins. So for Kandolo Limited, it would be crucial to conduct a detailed analysis on the cost structure, on its pricing strategies, on its operational expenses, and also to address any underlying factor that may contribute to the slight decline in profitability. So improving profitability through measures that you can suggest, like cost reduction initiatives, price optimization. You can also mention issues of operational improvement. These all can enhance any company's financial performance and long-term sustainability. So in conclusion, just on the profitability, although this is supposed to come at the end, I'm just commenting at each stage so that I don't start going back. So we can say the profitability ratios here highlight that there has been efficient cost management and operational effectiveness. So these are the submissions I can give at that point. Anything else? All right. So we go to other ratios. We have, by the way, I'm not just picking these ratios, you need to know where they're coming from. Okay, the gross profit as you get here, please don't make a mistake. Everything is about the ratios. Sometimes you have the formula correct, but you don't know where to get there. Okay, the gross profit, okay, 1.1 over the revenue. Okay, 2.5. 1.1 over 2.5. So 1.1 over 2.5. See, I'm getting the figures as they are. 1.2 over 2.7. Go here. Okay, 1.2 over 2.7. I'm taking the figures as they are. I just didn't pick arbitrarily. Are we together? Yes, there was a question.
Yes, I wanted to find out. In the cases where there are cases where you see the turnover and revenue, are they interchangeable?
Yes, it's the same thing.
Okay. Okay. Thank you.
Any other questions? No.
Mr. Collins, there's one where it's a paper where I saw they asked to find operating profit on equity. They
Operating,
added the word on equity.
operating profit and equity.
Yes.
Well, the same operating profit, yeah. Before interest and tax, operating profit after tax, it's the same issue. Okay, so it's the same figure. Yeah, but also be mindful, I don't know, those old papers for 20 before, let's rely on these papers he was preparing. I don't know who was preparing earlier on, but these are similar terms that he uses. Okay, so let's go to another ratio. So we are done with the profitability ratios. So we now go to investment ratios. Okay. What did we say were investment ratios? So investment ratios, basically, these will give us insight on how effectively the company is using its assets and equity to generate returns to shareholders. So we're going to look at 2015, 2016 ratios. So investment ratios. So which investment ratios are we looking at? We have return on assets and also return on equity. Return on assets and also return on equity. So we're looking at this picture here. So we have the formulas given as follows. So return on total assets and return on equity. So we have the profit before income tax over the total assets, and return on equity, we have profit for the year over total equity. So we go to our financial statements. Where is the profit before income tax? It's found in the what? Comprehensive statement. And the total assets are found in the balance sheet. So we go here. Okay. Profit before income and tax. So profit before income tax and over total assets. So let's go here in there. So profit.
Mr. Collins,
Yes, please.
profit for there it's the same as profit after tax, no?
Yes, this is profit after tax. That's the profit for the years after tax.
Okay.
So here we're going to the profit before income tax. Okay, before we remove the income, and then it's 208. All right, divided by what? The total assets. Where are the total assets found? In the balance sheet. Total assets in the balance sheet, which is 2.4. So 2.4, 208 divided by 2.4. So this is where we got the figure 208 over 2.4 times 100. Okay, the way I've picked this is the way you need to pick for 2015. 2015, we go to 185 divided by what? Total assets, 185 divided by 2.3. 185 divided by 2.3 times 100. Then return on equity, it's a profit for the year, which is profit after tax over total equity. So for 2016, we get 130 over 1.6, 2015. So now, using these ratios that we have, what is our interpretation? So what is our interpretation using these calculations? So as you can see there, the return on the total assets, they measure the efficiency of a company in terms of gearing from in terms of generating profits, not gearing, from its total assets. So here it indicates how well the company is utilizing its assets. So here we can see that Kandolo Limited has increased profitability from 7.87 to 8.6. So this one is suggesting that there's an improvement. The company is more efficient in generating profits from its total assets. Okay, we can see that there's an improvement, 7.87 to 8.86. Okay, this is for 2016. See this improvement, we have moved from 7.87 to this. So this is an upward improvement. So what does this mean? The implications are that a higher return on assets indicates that there's a better asset utilization and there's efficiency in generating the profits. So this basically reflects positivity on the company's operational performance and management ability to generating the returns for the investors. So it's a good sign. There's an add. So who wants to just quickly make an interpretation on the return on equity? What's happening from 2015 to 2016? Return on equity.
There's improvement from 2015 to 2016. There's an increase. So as an investor, I'll be very happy because I'll get my dividends and at a higher rate.
Okay. Great. Anyone else? So our return on equity, they measure the return earned on the investor's equity. So these ones indicate how effective the company is generating profits using the shareholders' equity. So there's been an improvement from 2015 to 2016 from 6.83 to 7.73. So basically this suggests that the company generated a higher return for the shareholders' equity compared to the previous year. So a higher return on equity indicates that the company is effectively leveraging shareholders' equity to generating profits. So this is a positive indicator on the company's ability to generate value for shareholders. So it may attract more investors. So what are the implications overall? Overall, the investor ratios here give us demonstrating an efficient way of utilizing assets in generating what? The returns for the company. So the increase both in return on assets and return on equity are giving the companies a picture that the management is effectively utilizing resources and equity to generating profit. So this is giving an enhanced picture of performance as a positive trend. Okay. So in conclusion, what can we say? Investment ratios are reflecting Ndolo's ability to generating returns from its assets. So this indicates there's efficient resource allocation, there's value creation, as well as continuous monitoring. So this is a good picture. Are we together? So we are done with the investment ratios. So now let's go to the efficiency ratios. So by the way, there are many efficiency ratios that are there, but he has only selected 2 for you. Okay. What did I say about efficiency ratios?
said that you can speak.
Yes, what let's say on the efficiency ratios?
Yes, you said it looks at how effective the company is managing its assets.
Okay. Looks at how effective the company is managing its assets. Okay, so we've been given two key efficiency ratios, the debtors days and the creditors days. What do these talk about?
For the debtors days, it talks about how effectively we are collecting our receivables from our customers. And the
All right.
creditors is how or effectively are we are paying the suppliers.
The time it takes for us to pay our suppliers and times it takes for us to pay our to get paid. Okay, so the debtors days there, they represent the average number of days it takes for the company to collect payment from the customers after the sale has been made. So this measure of efficiency on the company's credit management and collection policies. So here we have seen that there has been an increase, there has been a decrease from 14.58 days to 7.65 days in 2016. So is this a good thing or a bad thing? In
It's
terms
a
of
bad
I think
thing.
it's a good thing.
It's a
It's a
good
bad
thing.
thing.
Good thing.
Yes, a good
It's
thing.
a
It's a
good
good thing.
thing.
Why?
For
A
the
good thing.
debtors, it's a good thing. For the creditors, it's a good thing.
You need to comment it from you are the owner of the business, yes. As a company, yeah, it's a good thing, yes. Why?
Okay, for debtors, because the shorter the period it takes for me to receive my money, the better for the company. And for the creditors, the longer it takes for me to pay, the more room I have to settle my bills. The better for the company.
Okay, so
And
what's your comment on the
also,
creditors days and also on the debtors days?
So for the
I think
debtors days, it has reduced from, we used to take 14 days for us to receive our monies, but now it's taking about 7 days for us to receive our monies. Yeah.
Then creditors days, we improved or we have gone down?
we have slightly reduced.
Or we're stable, okay? Those are insignificant, those are stable, relatively stable. What's the implication? Okay, so let me start with the, you're all correct.
Yes.
So let me start with the
I
debtors
think
days. So the debtors days there, we have said that the days decreased significantly from 14 to 7, almost half, meaning that the company has improved in terms of efficiency in collection of their money. So this results in faster cash conversion from debtors to sales. So the implication is that there's improved liquidity and working capital management. Basically, this signifies that the company is doing well in managing its accounts receivable. So this will also lead to improved cash flow and risk of bad debts. The creditors days, on average, it takes for our company to pay our suppliers. So this measurement gives us a picture of how efficient we are managing our accounts payable. So there we are able to see that Kandolo remained relatively stable, indicating that there's consistent efficient management of our suppliers from 2016 over approximately 59 days to 59 days again, 0.27 in 2015. So this stable creditor day working period suggests that there's effective cash flow management and favorable relationships with our suppliers. So the efficiency ratios overall, we are simply demonstrating an improvement in data collection days and also remaining stable or consistent account payable days. So this gives a positive picture on Candor Limited on working capital management. All right. Are we following? Okay, so let's go to
Yes.
Mr. Collins, I have a question on the creditors' days.
yes.
In an event that we are given both the purchases and the cost of sales, which one can we pick?
Okay, first of all, okay, that's a good question. Before even looking at the answers, I hope you also understanding where we're getting the figures from. So data's days, we were looking at what? The data's, they come in terms of trade receivables over sales times 365. Okay, so let's go to our statement. The data's, we find them where? We locate them. Where the trade data's, okay? They're coming under our current assets. Okay, these are trade and other receivables. This is what? 54,000. Then we go to our revenue, 2.5. Okay, 54,000, 2.5. This is 54, 2.5 times 360. Okay, if I put this is the same as just put times 365 days. Okay, so this will give you 7. So here, for the creditors days, we get trade and other payables over the cost of sales. Trade and other payables over the cost of sales. So when we go here, we go to our creditors, which are coming as trade. So when we go here, where our creditors, trade and other payables, this is 230. Then cost of sales, we go here. Cost of sales, they are here, been given as a figure 1.4. 1.4. So this is a 1.4 there times 365. So the cost of sales. Now, where was the question?
The question is on the creditors' days. In an event that we have been maybe given the purchases and the cost of sales. So which one are we supposed to pick between the two when you are calculating the creditors' days?
You get the cost of sales because the cost of sales takes account of the purchases. But if you're not given the cost of sales, there's just credit purchase. In fact, we're interested in the credit purchases. Okay, you can get the credit purchases, but if both of them are given, you use the cost of sales. Okay, so we can proceed. So the last ratios that we are going to look at, the financing ratios. So what are financing ratios to do? What did we say about the financing ratios? So in this case, we
look at the proportion of debt to equity.
Yes, look at the proportion of how much loans or debt we have in proportion to equity. So here, our total long-term loans to equity ratio, basically, we're going to calculate our as follows. So total long-term loans to equity, total long-term to total equity. So the loans over total equity. So we go to our statements. Let's identify our loans that we have and our equity. So we go to our statements here. The loans here we have 304. The total equity 1.6. Okay. 304, 1.6. Okay. So this is 0.18 and 320 over 1.6 for 2015. 308. 304 over 230. And our loan is 320 over our equity. 1.6, 320 over 1.6. So this is where the figures are coming from. 20 over 1.6. So what is the interpretation? What is the interpretation there? So we can see that Kandolo's long-term loans to equity decreased slightly from 0.2 in 2015 to 0.18 in 2016. So this shows that there's a decrease in reliance on long-term debt relative to equity. So what does a lower ratio indicate? Is this a good thing or a bad thing?
It's a good thing.
Yes, it's a good thing. So the lower ratio here indicates that there's healthier capital structure where we are relying less on debt capital, okay, than to equity. So this reduction basically gives us a picture that the financial risk is being decreased. So it's also enhances the ability to creating a good picture and image of our company to probable investors, because when investors are looking at a company that totally relies on debt, they become worried. There's a probable financial risk. All right. So generally, the implications are that there's a slight improvement on the capital structure with a reduced reliance on long-term debt compared to equity. So this lower ratio of the total long-term loans to equity suggests that there's an improvement in the financial stability and reduced financial distress. So it's a positive trend in financial ratios, which indicates prudent financing management and a healthier balance between the debt and equity in financing Kandolo Limited. All right. So we are done on the...
Mr. Faring.
Yes.
Yeah, a question on the debt to equity. Can we, as a general comment, can we also say that any company with a debt ratio of 50% is considered to be highly geared, and vice versa, where the debt ratio is below 50%?
Yes and no. Debt to equity, if it's 50% or above 50, it means if it's 50%, meaning 50% of its financing sources are coming from equity and 50 coming from debt. Above 50 means the majority of the company's financing is coming from debt. Okay, even the 20% was not very bad. Okay, so your general assertion is also true. It's not healthy for a company to have its majority financing coming from debt. So even if we're at 20, we've gone low, meaning we are relying more, meaning at 20, it means that 20% was debt and 80% was equity. So now we've gone to 18%. It means, okay, we're actually reducing further on our financing emanating from debt, and we are leaving a huge amount remaining coming from the real owners of the business. So I think that's what I can say in a nutshell. Otherwise, that's true also. Okay, thank you so much. So we go to another question. So we are done with
Mr. Collins.
Yes, please.
Can I bring you back?
Uh-huh.
I joined in a bit late, so I didn't know how you found the cash ratio. I think I've been trying to do that, but I haven't been able to find the formula.
Okay, cash ratio. Can somebody help those that did we calculate the cash ratio?
Yeah, I think we used the cash and cash equivalent or the cash and bank over the liabilities, the current liabilities.
So cash and cash ratio, basically, depending on what is the income statement. So sometimes it's cash and cash equivalent. So we're looking at this, the available funds to meeting our liabilities. So cash and cash balances divided by the total, the current liabilities. Okay, so this is how we calculated it.
All right, thank you.
Yeah. Is that clear? So we go to the other ratios. Okay, so we're done with all the ratios. This is the full. So remember, there's the quantitative part and the qualitative part. So I was emphasizing on you understanding what's really happening. The figures will give you grades, but the interpretation more. So what? Okay. Why is whatever is happening? So maybe let's go to question number 4 on the ledger accounts. Okay, the ledger accounts. Are we ready? So we know that this is a fundamental aspect of accounting, where we need to know how to cross from the T accounts to the trial balance, then formulating the income statement. Okay. So the ledger accounts, what are their main purpose? We have different types of ledger accounts. The general ledger, purchases ledger, the sales ledger. So these ledgers follow principles of double entry bookkeeping, which assume that for every transaction, at least there should be 2 effects, a credit and a debit. So these follow principles of consistency, materiality, the matching principle. So for every debit entry, that will be a corresponding credit entry. Okay, so in accounting or bookkeeping, we need to understand that there are books of prime entry or source documents, which we call books of prime entry, like invoices, receipts, checks. So these ones are journalized. To journalize, basically to record in journals. So we have the debit side and the credit side. These all follow what we call a duality concept. So every debit entry, debit the what's the rule? Debit the what? Giver and credit the receiver, or credit the receiver. What's the rule for non-accountants? I know you're writing, but you should.
The receiver.
You're debiting what?
It's debit the receiver, credit the giver.
Yes, debit the receiver, credit the giver. So there are different types of accounts. We have asset accounts, we have liability accounts, we have equity accounts, we have revenue accounts, we also have expense accounts. When you're dealing with these ones, at least you should need to know. Remember the concept we use under perils. So when dealing with asset accounts, you need to record resources owned by the business, such as cash, inventory, equipment. So I'm going to use perils as well, as I will be doing the T account. We said perils, debit, and credit. P-E-A-R-L-S, the word perils. So all purchases have a debit balance, expenses have a debit balance, assets have a debit balance. To increase assets, debit them. To decrease them, credit opposite. To increase expenses, debit. To decrease them, credit. To increase purchases, debit. To decrease them, credit. Then here, revenue capital, to increase it with credit. Okay. Liabilities, to increase them with credit. Sales, to increase them with credit. Okay. For these three accounts, I will need you to work with me slowly. For the others who are basically almost learning this for the first time, even if they're writing in the afternoon. So let me create a worksheet. After this, what are we preparing for? Managerial economics. So as soon as you are done in the evening, we start managerial economics. Okay, then QM will do it, I think, afterwards. So now, let's participate here. Makoka registered a new company code, Makoka Enterprises Trading with Accra, started operating business October 1, the following took place. So January 1, company commenced business with 150 cash from Makoka as the only stakeholder or shareholder. So what transaction do we put there? What is that transaction there? Quickly. Are we seeing? So January 1, started business.
On January 1, we credit Makoka and debit cash account.
Makoka is the owner.
We debit Makoka, then credit capital account.
Good. Remember pearls? Don't forget pearls. So there's capital involved. What is equity or capital? Money used to start a business. So it's capital. And what? What other account?
Isn't it Makoka?
Makoka is the owner of the business.
It should be bank.
No, cash.
Yes. Okay.
Cash account.
So cash account Makoka. So why are we putting to increase, remember under perils, to increase capital, we credit. So how much? 150. And here we put capital. Why are we debiting capital? To increase assets. Cash is a asset. Okay, so
Yeah.
under perils.
Hi,
Yes, please.
I'm good. How are you?
Please mute yourselves.
No.
Perils, right? We're consistent with this. Debiting and crediting. So we are increasing the revenue, which is capital. We are debiting 150. Then cash is an asset, increase it to that. January 2, 150 of the cash was paid into bank opened at Zanaco. So which accounts are we looking at? Cash and bank. Which transaction is giving and which one is receiving? Quickly, at least somebody to answer
I
something.
think bank is receiving, then
The bank is
cash
receiving.
is given.
Okay. So bank is receiving and cash is what? Giving. Are we agreeing? So we're just, it's a contra entry. We call it a contra entry. Whenever it's happening within the same business, it's just a portion of that cash that we started with, which was the till, was taken into the bank. So we are reducing the assets of the cash by 140 5, then you're taking that money into the bank. So here we're going to say bank 145,000. Then the bank is receiving, so here say cash 145,000. All right. Are we together, Debbie? Are we understanding? Right. I want to take my time, especially those that have not done it. It's a very delicate moment. I can't cruise. So we are done with this transaction. So also, but
Sorry to ask.
uh-huh,
On the payrolls, the P is for what?
purchases, expenses,
Purchases.
yeah, purchases,
Okay.
expenses,
Expenses, assets. Then
revenue,
on the other side, there's revenue.
liabilities,
Okay.
and sales.
Okay. Thank you so much.
Okay, so we are now on part C. 16th January, the company bought a van on credit from Total Zambia 330. So what's happening? Who wants to try?
So maybe there's going to be van. I don't know if we call it van or
Yes,
asset,
account.
van account, and then there will be Toyota Zambia.
Good.
So we'll debit the van, then
Mhm.
we'll credit Toyota Zambia.
Excellent. So the van is an asset. So to increase assets, we are debiting. So van account will be debited. Who's Toyota Zambia? To us, a creditor. Creditors are liabilities. So to increase liabilities, we credit. Creditors always have a credit balance. So we open a van account and Toyota Zambia account. Okay. Van account, Toyota Zambia account. So the van, we are 330, we're going to put Toyota. $30,000. Okay, then here we're going to have what? Van 330,000. So the title is an entry in the other and vice versa. Those that haven't spoken, the company rented premises for 15,000 per quarter and paid for 6 months immediately by check. 6th January. Which transactions are obtained in that transaction?
Bank and then
Yes, still listening.
I think there should be a rent account and a bank account.
It's a detailed statement here. There's rent, yes. So the shop rented premises for 15,000 per quarter. Okay. So they paid for 6 months immediately by check on 6th January. So there's rent and bank account. So what are we debiting and what are we crediting? Rent is what? An expense. So we're going to debit it. Then we have what? Bank is giving out money. So the company rented shop premises for 15,000 per quarter. A quarter is how many? How many months?
4. 3 months.
3
Then
months.
there are
months.
4 quarters.
In a year, the 4 quarters in a year. So we paid how much? 1,015 for 6 months. How much did we actually paid? Did we pay 15,000 or there's some English I need you to disintegrate? So the rental price per quarter is 15,000, but did you pay 15?
No, they paid double.
I think it's 6 months,
Is it
meaning
30?
that's 2 quarters.
15,000 is for 3 months. So 1 month is how much? 15. About 1 month? We don't know. So you cross multiply. So 15 divided by 3, meaning per month it's how much? 5,000.
Mr. Collins, we're getting feedback from, I don't know, maybe someone's mic is on.
Okay, let me mute. This question was a little bit tricky on this account, just small calculation. I repeat, the company rented shop premises for 15,000 a quarter. So a quarter has 3 months. So in short, this 15,000 is for 3 months. So 1 month is, you divide 3 into 15. So 1 month is 5,000. Are we together on that?
Yes.
So we actually paid for how many months? 6 months. So we multiply 5,000 times 6, which is 30,000. So this is the amount that we're going to record. So there are 2 transactions, the rent account and the bank account. So we go to the bank, we're paying out rent, which is how much? 30,000. Then we go to rent account, rent, we're receiving the service of rent. So you're going to say bank. So people have a problem here. So why do we debit bank? Why do we debit rent when we're actually paying out? When debiting the expense, we're enjoying the rental service. So under payrolls expenses, we debit them. All right. Let's go to part E. The good part is for every entry you get a mark. Who wants to help on part E? Okay, the guys, then part F, the ladies. Let's go on.
For E, we have purchases account and case limited.
Yes, so the part E, company bought goods on credit from Case Limited 144 on 10th January. So what are we saying? What 2 transactions are we looking at here? Yes, no.
We have purchases and case limited.
Purchases and Case Limited, correct. So whose case to us?
Our creditors.
Our creditor, yes. And then purchases. So using payrolls, purchases have a debit balance, right? Creditors have a, so we open purchases. And Case Limited. Creditor. What was the amount? 144. So we say pays 144,000. Then purchases 144,000. Okay, so let's go to another transaction. If the lady's company paid shop expenses amounting to 11,500 by check.
Okay, so the two accounts there is the bank account and the shop expenses account.
Okay.
So will the company paid shop expenses, so we'll debit the shop expenses and credit the bank.
Okay. So we have shop expenses from here and bank good. So shop expenses, since all expenses have debit balances, we're going to debit the bank, we're going to credit because one paying. So the amount is 11,500. Okay. Shop expenses. The bank already have. So the amount that we have in this case is what? 11,500. So shop expenses 11,500. Then we go to bank 11,500. Are we together? All right. So let's go to G, 11th January. The company sold goods on credit to NAMS for 183,000. What two transactions are we having there?
We are having the sales account and NAMS Traders Limited.
Okay.
So we're debiting NAMS and crediting sales.
Great. So we have sales. Whenever you sold goods, the sales, bought goods, purchases. So sales and NAMS. Who's NAMS to us? Data. Using our payrolls account, sales have a credit balance. Okay. And data have a debit balance there in the umbrella of assets. So we're going to open sales and NAMS account. Sales and NAMS account 183. Sales NAMS account 183. But here we're going to say NAMS 183,000. You're going to say sales 183,000. Are we following? Okay, the gents now. H on 20th January, NAMS Limited paid 83 by check. This was deposited immediately into bank. The gents, transaction H. Okay, ladies, take it up.
Let me
We
try.
have names to
Right.
details.
Are we crediting NAMS and debiting bank?
Okay, so NAMS paid 83 by check. Okay, so who's NAMS to us in the first place? NAMS is our what? Our
Credit.
debt, but is time to repay. So we're reducing. So to reduce our debt, we credit instead of debiting. Then the bank is receiving 83. So we debit bank. Bank is receiving from NAMS. So we go to bank, NAMS, $83,000. Okay, we go to NAMS here, bank, 83,000. Okay, are you following? Then the last two, 24 January, company sent check to K's Limited, 130. Who was K? Our creditor. So we are paying by check 130. So 130, we go to bank, K, 130,000. K is our creditor. Creditors have a credit balance, but we're reducing here. So we say bank, okay, 130,000. Okay. Then here, as at 31st January, total assets, total cash sales for the month amounted to 92,000. So cash and sales. So cash is receiving, sales, all sales have a what? Credit balance. So cash sales, 92,000. So we go to cash, we debit cash, 92,000. We go to sales, cash, 92,000. So now we need to close these books up before we post them to the ledger. So the first one is create all necessary accounts, 10 marks. Balance of each 5 marks. And post the trial balance, 10 marks. Interesting question, right? So how do we balance up? You just close the account like this. You get the total. What total do we have here? 150,000. 150,000. Then if this amount is there, the side that doesn't have to give it, it's got the balance what? Carry down, 150,000. Then the balance brought down, it goes to the right diagonal. If it's inside, it comes here. Balance brought down, 150,000. So this is a credit balance for capital, you know, under bills. Trial balance.
A question.
Mm-hmm.
The statement we put on top there, where we say trial balance, is it supposed to be as at T or at the end of?
As at.
Okay. It's only the income statement and the other one which is at the end of.
Yes, trading account, yes.
Okay.
So 150,000. Can even be starting from behind here. NAMS, we can balance off here. So if you have two figures, you pick the biggest figure. So this is a 183. 183,000. 183,000. Then Ushkwete, you give them. So Ushkwete, so the totals up. So 183 minus 83, what is it? Carry it down. It's 100,000.
100.
This 100 will go to the other diagonal here. balance brought down, which is 100,000. So NAMs are data. So NAMs or trade receivables if you want. It's the same thing. Okay. Data 100,000. Control account, sometimes we just open one book for creditors or one book. So here sales. Okay, we only have one side here. So we just total up here. This is 5. Okay, 17. 275. 275. So which creator who we just keep them here so the totals up. There's 0 inside 0 minus that is 275,000. Then balance brought down 275,000. This is what? Sales. 275. Right. Have I lost anyone? Are we moving together? Have I left anyone behind? Before I proceed, please. Speak now. Okay. We go to our next transaction. Shop expense. So the shortcut is just this figure. This is the only one. Just it will be the balance brought down here. 11.5. Why? The total here. 11.5. 11.5. Balance. Pare down. 11.5. So the shop 11.5. Shop expenses. So shop expenses 11.5. Okay, so close this, close this, close this. Okay, purchases, same here. Balance here, got 144,000. 144. 144. Very down 144. Purchases of 144. Mr. Martin, are we together?
Yes, Mr. Collins.
Okay, I hope I haven't lost anyone. All right, so we close purchases. K was a creditor. So here we pick the bigger figure here. What is it? 144. 144. So who should equate what's the balance? 144 from there. 144 minus 130.
14.
14. Okay, 14,000 confirmed. So here to come here and balance 14,000. So who's K? The creditor. So it's a creditors. Pay 10,000. Okay. So if there are many creditors, you can lump them up into one. Okay, so we're done with this. Toyota is another creditor. So you can combine them if you want. Okay, 330. 30,000. Here balance brought down 330. Right down 330. So to avoid. So anyway, you know what I'm talking about. Good. I'd have loved this on just one figure as what? As creditors. So this will be 144. You get that, huh? Preferably. Done with this. Remaining with these three. So rent. This is 30,000. 30,000. So we know what we're doing inside. In the interest of time, rent, using payrolls, there's a debit balance.
For
Right?
Toyota, is that 330 or 33,000?
Toyota's 330, isn't it? 330.
Where is it? Did I miss something? Because I just wrote one on Toyota, which is
330 here. Bottom line.
okay.
So 330 here. Okay, then we go to van account. Balance brought down. Actually check if you put it at the same line. It's 330. The rest you know, he is carried down 330. Mkatum 330. 330. So van 330. Why is van debit an asset or assets have a debit balance? Okay. Then we remaining with what? Bank, capital, and so here what we do, we get the totals. 183 plus 145, what do we get? Give me the totals aside.
$228 debit side.
228. Credit side.
$171,500.
171,500. Difference.
$56,500.
6,500. So we pick the bigger one. 228,000. 228,000. The difference, you give it to the smaller guy. Write down 56,500. Then brought down 56,500. So this is what will go to our debit balance. 56,500. Right. This is where balancing is interesting. So we're done here. Okay. Capital we already did. So remaining what? Money. So what do we do here? We find the totals. You want 45,000. And here
242,000.
242,000. Difference.
$97,000.
7,000. We give it to the smaller guy. And 7,000. Brought down about and 7,000. Deborah, are you there? Gosh. cash. 7,000.
Hi, yes, I'm here.
Are you following through?
Yes, I am.
Okay, so now we total our place balance. That the thing is, when exam that balance, it only balances when you're doing it from home. Every entry has a mark. So don't force it to balance as such, but make sure that you understand what is happening. So let's total up on either side. What are we getting?
$9,000 on the credit side.
59? What's the total?
I'm finding 439,000 on the debit side and 769 on the credit side.
Sure. Ideally, it's supposed to balance on both sides. So did we leave out any transaction? Is that what the rest of you are getting? Happy to 150,000.
Sorry.
I'm
I've
finding
on sales.
Uh-huh.
On sales, we wrote 275. Were we not supposed to write 92, which is the difference?
The sales.
When we got the trial balance, I'm seeing we wrote 275.
Oh yeah, the difference here. So this is 275. What is the total here?
Because the difference was no, sorry, no, we're okay. Sorry.
What was the total here? Oh, there was no figure there. 275.
There was no figure, so it's fine.
Okay, so this is okay. Debtors is okay. Sales 275. This is 144.
I'm finding 669 on the debit side
Six.
and 769. Yeah, 669,000.
And
Yeah, and then the other side 769. So I
769.
don't know where.
100, eh? Is 100.
Yeah, 100.
Okay, where is the 100? Missing. Did we miss any transaction here? The 100,000. That was 100. How did we treat that 100 somewhere? So 100 in here. Data is now 100. Where's the 100 coming from? Did we? Anyway, let's not waste much of the time, but at least these are all the entries. Yes, somebody speaking? Yes, Sue?
After this, I saw 100,000 somewhere.
Yes, on NAMS here, this 100. Did you take note of it?
On the key account. Just go after this. Oh, so there's okay.
Okay, there's 100, I think that we would have just omitted somewhere, but otherwise I've addressed most of the issues that we needed to look at in this question. So this is how you get your 25 marks. Yeah. All right. So we already tackled this yesterday on the roles of committee member. We also illustrated types of budgets and explain. We did that. We also did capital budgeting, calculated it's an area supposed to be payback period and PV to beat index, and I explained all this. So done that, done this, covered this. We also did the conceptual framework. All right. Now the last question. So we've done also ratio analysis. So just remaining one question. We're done with 2018. Any content so far? Do we need a break? Continue.
You can continue.
Okay. Are we getting better or confused? How are we moving? So we are what topic is this?
This is, I think, CVP.
CVP. Okay. So what does CVP really look at?
Is the cost, volume, and profit.
Cost, volume, and profit. So what is the essence of this particular topic? I usually love to get from there so that people understand the background before we get in there. So this is under CVP, which is also called break-even analysis. In financial accounting or management accounting, it's a financial tool which is used by businesses basically to determine a point at which our total revenue will be equal to our total cost, which will result in either making a profit or a loss. Basically, it helps us to understand the minimum levels of sales that are needed to cover all the costs. The components that we need to understand are fixed costs. What are these? These are expenses that will remain constant in production regardless of what our production levels. So the fixed costs include rent, salaries, insurance, etc. We also have what are called variable costs. These are expenses that do change with the levels of production or sales. So examples are raw materials, labor, utilities. Then we also have what we call the contribution margin, which is the difference between the selling price per unit and the variable cost per unit. So the contribution margin, basically, it contributes to covering fixed costs and generating profits. We also have a break-even point. What is a break-even point? This is simply the level of sales at which the total revenue is equal to total cost, resulting in zero profit or zero loss. Are we together? We also look at calculating break-even in terms of units and break-even in terms of value. So break-even points in terms of units is simply the fixed cost over selling price per unit minus variable cost per unit. In value, it's simply break-even points in units times the selling price per unit. So we also have, we're going to talk about what is called the margin of safety. I've already talked about the break-even. Okay, so margin of safety basically represents a difference between the actual sales and the break-even point. So this one helps us indicate how much sales can drop before the business starts incurring losses. So we can calculate that in units and in percentage. So margin of safety in units basically is the actual sales minus a break-even point in units. Then in percentage, it's a margin of safety in percentage. It will give you the margin of safety in units over the actual sales times 100. Then we also are going to talk about how explain these later on. Basically, meeting target profits is important in businesses because we often will set our targeted profits to use, and we use the break-even analysis to determine basically the level of sales that are required to achieve these targets. So profit targeted is equal to fixed cost plus targeted profit over the contribution. So sensitivity analysis is also covered in here, where we use it to assess the impact of the changes in the variables like the selling price, the variable cost, the fixed cost, all these on the break-even point profitability. Then you also asked to, in 9 marks, to explain the limitations of break-even analysis. What are the limitations? We have several limitations. Number one, the break-even analysis relies on a number of assumptions like fixed costs, linear relationships, a constant selling prices. These ones may not always hold true in the real world. The limitation also that this topic has is that it doesn't consider other factors like demand, competition, changes in consumer preferences. These ones also have an impact on the business operations. Break-even analysis also has a limitation in that it provides insights based on a static snapshot, a pictorial imaginary snapshot. It doesn't take into account the dynamic changes, environment that can change over time. So generally, how do we apply this topic? This topic is applied widely in many business avenues and businesses of all sizes and industries. They use this to make informed decisions on the pricing strategies, cost management strategies, volume, production volumes, etc. So it's also applied in that it helps in evaluating the financial feasibility of new products. So break-even analysis also is used to assessing the impact of cost changes and setting realistic sales targets. So this is an important topic all in all, because it's a valuable tool for businesses to understand their cost structure, to also assess their profitability, as well as making informed decisions. So we can start now doing the calculations. So we're going to look at the break-even point, part A, in terms of quantity, and break-even in terms of value. So who remembers the formula? It's a formula for break-even point.
Formula is it's fixed cost over contribution per unit.
Fixed cost over
contribution per unit,
which is given by, what's the contribution? Do we have contribution?
Selling price per unit minus variable cost per unit.
Yes. So what is our fixed cost there? So selling price per unit over variable.
30,000.
Selling price per unit minus variable cost per unit. Okay, so our fixed cost in this case is what?
30,000.
Yes, 30,000. Then our
selling price is 3 kwacha.
Mhm.
And our variable cost is 1 kwacha 15.
Correct. So this is how it will come, the break-even point, fixed cost, selling price per unit minus variable cost per unit. So 30,000 over 3 kwacha minus 1 kwacha 15. So this will give us in units 20,000. Okay. Then in value, what do we do?
You multiply the break-even point in units by the selling price.
Yes, so these units, multiply them by the selling price. So 20,000 units times the 3 kwacha selling price per unit, which is 60 kwacha. So this is how this question would be answered, as simple as that, 4 marks. So break even is fixed cost minus selling price per unit minus variable cost per unit. So fixed costs have been identified. Are we together? Margin of safety. How do we compute the margin of safety?
PP in
The
units.
budget minus PP units.
Yes, budgeted sales minus what?
Break
EP.
even.
Point in units. Good. Okay. The budgeted sales, which in this case is what? So this will be
48,000.
budgeted sales minus what? Minus break-even point in units. Okay, so this is, what is our budgeted sales? 48,000 minus break-even point in units. 8,000 minus what? What we calculated as
20,000.
20,000, correct. All right, so this is what will give us our margin of safety in units. So our budgeted sales minus break-even in units. So 48,000 minus 20,000, which is 28,000. In percentage, it's a margin of safety in units over the budgeted sales times 100. So the 28,000 divided by the 48,000 times 100. So which we get as 58.33%. Okay. The question here, Sue? Your volume is very low. Please increase.
Can you hear me now?
Better.
Can you hear me now?
Loud and clear now.
Can you hear me now?
Yes, you're loud and clear.
Yes. What you are required to calculate the margin of safety, but you haven't been given the budgeted sales. I don't know. I think I saw a question where there's no budgeted sales indicated.
Okay, how do we calculate our margin of safety in the case that you are not given the budgeted sales? Anyone to answer that question?
Maybe on that one, maybe the budgeted sales were given, the budgeted sales in value were given, and the budget, so, and which were we supposed to divide by the sales price to come up with the budgeted units.
Okay. Has the question been answered?
I couldn't quite get that. Maybe you can.
What I'm trying to say is there's no way we can find without the budgeted units. So in that case, maybe the budgeted sales in value were given. So we are supposed to divide now by the selling price to come up with the budgeted units.
All right.
Thank you.
Clarified. Okay, thank you so much for that. We encourage more of this so that we, as we bring questions, we make it like a discussion. So part D, we're asked to calculate the break-even point if the selling price was increased by 15% and variable costs were reduced by 2% and the fixed costs remained constant. So can somebody explain what is they're trying to get to? So they want us to calculate the number of units to meet the targeted what? The targeted profit, the targeted profit target. So we are being given precise instructions there to calculate the break-even point if the price was increased by 15% and the variable costs were reduced by 2%. So what is our selling price? Yes, Sue? Hand is up.
Sorry to draw you back. Have we tackled question C?
Oh, that's good. Question C. No, we haven't. Question C, actually, calculate the number of units required to be sold to meet a profit target of 60,000. Actually, it's one we need to do. So we need to calculate what? The number of units to be sold in order to meet a target profit of 60,000. So when there's target profit, what formula do we use? What's the formula for the targeted profit?
Maybe. Let me just give it a try. I'm not too sure. Is it fixed cost plus targeted profit over, I don't know if it's contribution per unit or BEP, I'm not so sure.
Yes, correct.
I think contribution per unit.
Precisely, that's the answer. Yeah. So the targeted profit, we need to calculate the fixed cost plus targeted profit divided by, okay, so this is how we calculate it. So our targeted profit we've been told is to meet our target profit of 60,000. So first we need to calculate our contribution per unit margin, which is the difference between the selling price per unit minus the variable cost per unit. So this was 3 kwacha minus 1 kwacha 50 weight, which gives us 1 kwacha 15 weight. So to find the targeted profit, we're going to have the fixed cost, which is our 30,000 plus 60,000 divided by the contribution per unit, which is 1.5 into that one. It's giving us what? 40,000. So we add 30,000 plus the 40,000 here, which is giving us our 70,000. Are we together? So we are being asked to calculate the number of units that are required to be sold in order to meet the targeted profit of 60,000. So we use the formula that the lady just given us. So the number of units with the target profit will be what? Fixed cost plus targeted profit over contribution per unit margin or unit contribution margin. So our fixed cost 30,000 plus 60,000 bar 3 minus 1.5. So here we have 30,000. What is 60,000 over 1.5? 60,000 minus 1.5.
40,000.
40,000. So here we're getting 20,000. Okay. Okay. So let's go to,
Collins,
yes, please.
I have a question.
Mhm.
I don't know whether to ask it on this one or maybe it can come later. I wanted you to share a bit on the cash operating cycle.
Okay, it'll come on another question. Let's finish this. So part D, we're given calculate the break-even point if the selling price increased by 15% and the variable cost reduced by 2%. Okay, what are they asking us to do? So we need to make adjustments. Okay, selling price has increased by 15%. What is our new selling price? Just multiply. What is our old selling price? 3 kwacha per unit, right? Or 3 kwacha. So just multiply 3 kwacha times 1.15. It has increased by 20%, 3 kwacha times 1.20. Then the variable costs have reduced by 2%. Okay. We can multiply it by 0.98, or I don't know how your math is. You can multiply by the percentage. I like finding easier ways of doing things. Okay, so firstly, we know that there's an increase of 15% on the selling price of 3 kwacha. So the 3 kwacha plus the increment. So 15% of the 3 kwacha is 45 ingwe, or 0.45. So you add this to the 3 kwacha. So our new selling price would be 3 kwacha 45 ingwe. But the variable cost was reduced by 2%. So those 1 kwacha 15 ingwe, we subtract 2% of 1 kwacha 15 ingwe. So this is about 0.03. So we subtract 1 kwacha 15 ingwe minus 0.03, we get 1 kwacha 47 ingwe. So now we need to calculate our break-even point with the particular changes. So here we're going to have what? 30,000 over 3.45 minus 1.47. So what are you getting? So we get the computation. So this is how we treat, that was carrying about 6 marks. So this is how we treat the part D. You will just adjust based on the advised adjustments to be made. Anyone behind? Are we together?
Mr. Collins, sorry to take you back. Can you please just go back to the break-even point calculation?
Okay. This one. So we know break-even point in units is given by what? Total fixed cost over selling price per unit minus variable cost per unit. So our fixed cost is still the same, 30,000. Okay. Our selling price was initially 3 kwacha and our variable cost was 1 kwacha 15, but we need to adjust these ones here. So let me give you a hypothetical example. If we had 10 kwacha for selling price and it has reduced by 20%, just multiply 10 times. What is from 100 kwacha? What is 20% from 100 kwacha? 80%. So 0.8. So this will be 8 kwacha. If it was 20 kwacha and we're told that it has increased maybe by 15%, just multiply 10 times 1.15, which will give you 11 kwacha 15 ngwee. I don't know why this is helping. This percentage you base it on the 100%. If there's an increase, you add it to the 100% or to the 1. So any increase, it will be 1.15. If it was 8%, 1.08. If it was 12%, 1.12. You multiply it by the outstanding figure there. If it reduced by 10%, we know it's 100% minus what? 10% will be 90%. So it will be 0.90. Okay, if it was reducing by 3%, that's 100% minus 3%, 97%. So you multiply the 10 kwacha by 0.97. If it was reducing by 40%, so 40% from 100% is what? 60%. You just multiply the answer by 0.60. I'm using figures that are easy to understand. So here, it has increased by 15%. Just multiply an increase by 15% on 100%, so it's 1.15. So 3 times 1.15. So our new price here will be 3 times 1.15. 3 times 1.15.
0.45.
3.45. Okay, which is the same as what we've done here. The 3, if you're doing it the grade 1 way, 15% times 3, it will still be the same thing. It's a shortcut. Now the variable cost reduced by 2%. So 2% from 100%, 98%. So just do 1.5 times 98% now. So 0.98 directly without subtracting anything because it's reducing. So when you calculate that directly, it will be 1.5 times 0.98. So this will give you 1.47. So here it will be 3.45 minus 1.47. And you get the answer. Okay, are we there?
Okay, thank you.
So we are done with this topic. So we finish the entire paper.